another episode of With Sonar. It's Wednesday, middle of the month. We've got a great lineup for you today. We're going to be talking about all kinds of things, including that margins on physical goods may be increasing. We're going to talk about where used truck prices are. We're going to give you a state of the market update. And then don't forget the future of supply chain. Our next conference is coming up in Cleveland on June 21st and 22nd. It's going to be a great event, obviously, because I'll be there, as will Tanner. But it's going to be exciting. We're going to hear from a lot of different folks there, a lot of Sonar customers. Coca-Cola will be there, Shopify will be there. DHL will be there, among many others. It'll be a very exciting event. I'm looking forward to it. And I don't think I've ever been to Cleveland.
Yeah, I haven't either. Really looking forward to it. Rock and Roll Hall of Fame is the house that we will be in, so really looking forward to that. It'll be a great time, and we're about a month away.
About a month away. Yeah, it's gonna be exciting. It's gonna be a great time. A lot of industry leaders there, a lot of thinkers. With Sonar will be happening along with a lot of other shows. It's interesting when we last had Future of Supply Chain. So last year in Northwest Arkansas, the conversation I remember. So this is interesting. I remember having these conversations. I think about the events that I went to last year, and the very first event that I went to last year was Food Shippers of America. It's a conference held every year, and that was in February of 2022. At that time, we already started to see the market soften in the Sonar data, but at that point, everything was still at all-time high, contract rates were still rising. And I remember talking to a couple of carriers there I was saying the market's, it looks like it's flipping, guys. It's coming down. We didn't know how soft or how much it had come down obviously it is today, because this was only February of 2022. And they thought I was nuts. Then we get to Future of Supply Chain. All of a sudden, it's okay, guys, there might be something here, but contract rates were still right around their all-time high, right? That was at Northwest Arkansas. Then you get to F3, and everybody's like, yeah, guys, market flipped. But it's going to rebound. But yeah, we see that it flipped. Now here we are again. I went to that same Food Shippers conference again. Everybody's like, man, it's bad. It can't get worse. Tanner, where are we going? What's the conversation going to be like at Future Supply Chain?
Yeah, it's going to be a rough conversation because I think even in May, you're talking about at the beginning of May, everybody's like, okay, we're at a bottom. We're looking good. We're eventually going to recover. We're kind of maybe there'll be some summer produce, and it hasn't happened yet. So the conversation, it's going to be a tough one. It's going to, people are going to ask questions about where do we go from here? Who's got the right data? What are my options? I think it's going to be a little bit more, I'd say, hectic and a little bit of a frenzy more than it's going to be more about we're seeing this and we're seeing that.
Yeah, I think you're right. And it's we're still seeing pretty high inflation numbers too. And I don't think that's helping. And a lot of companies are trying to get their margins back. We've been looking a lot at the PPI index, which is basically the cost that manufacturers have to pay in order to get their goods, compared to the CPI, which is the consumer price index, which is really the price we as consumers pay. So as that goes up, it means we face inflation. If PPI goes up, it means that businesses are facing that inflation.
Absolutely. And over the last 2.5 years, as that inflation has gone up on producers, they haven't necessarily passed all that off onto consumers. We've seen the margin compression from a retailer's perspective, and now I think those margins are starting to expand again. So it's going to be interesting to see what we do with inflation. It seems that the Fed, Luke, what is your opinion? Do you think that the Fed has done fairly well on a soft landing with inflation, or do you think that they have a lot more room to go?
I feel like you just asked me a multi-trillion-dollar question, and I love it, okay? I am all about it. Yes, I will happily partake in crystal ball predicting. Honestly, if you had asked me this question 6 months ago, I'd be like, they're morons, what are they doing? Now I'm like, maybe there's kind of sort of a soft landing coming. We'll see. We haven't felt the full impact of the increases. That's true. So there is a layer of unknown there, but is it a pleasant landing? No, it hurts. We all feel it, but I think that, I'm going to sound like a broken record here, but if the job market holds up somewhat, sort of like it still is, then yes, I'd say the soft landing is achieved. The question, though, is the participation rate is a little lower, so it's not quite so even though The unemployment rate is at an all-time low or right around it. The participation rate is not at an all-time low. So, you've got some questions there, I think, to ask. But, I mean, right now it kind of feels like they're in line or hitting that soft landing. It feels like it right now.
Yeah, it does. I respect the fact that Jerome Powell and the Federal Reserve have stuck to their guns.
Yeah.
They've kept the same message. They haven't changed what they've been doing. They're on the same game plan. I think he's got a few challenges ahead of him. I think 2% inflation is no longer realistically like an achievable number. They set that back in 2012. So think about that. 2% expectations have been in place for about 11 years now. The amount of growth that our GDP has had, the amount of growth that our entire country and the world has had, I don't see 2% being a realistic number anymore.
Do you think it needs to be higher or lower?
I think it needs to be higher. I think we're looking at, honestly, roughly a 4 to 5% inflation rate as an expectation.
I think they raise interest rates again. I don't think they're done. I don't think they're done.
I think he has also, I agree with you, because I think there's going to be a huge decision in the fact that what happens with student loan debt. That's going to be a huge impact. I mean, you're talking
a lot of money coming out of the monthly budget.
$500 on monthly budgets of disposable income that consumers have had freed up the last couple of years. So
absolutely, yeah. That's actually, I think, a bearish sign for the freight markets, right? I mean, we talk about that. So if student loan repayments come back in, what does that have to do with the freight markets? Well, if people now have $300, $500, $800 less a month to spend buying stuff, what does that mean? Well, if they're buying less stuff, there's less goods that are moving, less freight volumes. We could have another leg down. Now, it may not be that extreme, but I would say that's certainly not a positive sign for the trucking market. We've already seen people shift, a lot of their spending back to services. If you take more money out of their budget, there's a chance that could take away from some of their physical goods spending.
Absolutely. And I think we've kind of already seen that, right? Inflation has started to slow down. People have stopped spending money because they've been putting so much money on their credit cards. And you got to think the reason that the freight market was so good over the last couple of years is because of that demand. And leading into our next topic is drivers. I mean, you could not find a truck anywhere. So if you wanted to enter the market or if you wanted to upgrade your truck, you couldn't find one. So therefore, that increased the demand for the truck prices, an 18-wheeler semi-truck price. And moving on to our next chart here, looking at the average 3-year-old truck price in the marketplace. This steep peak is very high. I mean, so as of 12 months ago, so May of 2022, the average 3-year-old semi-truck was worth about $140,000, Luke.
It's a lot of pizza.
It's a lot of pizza. And the problem is that's okay. If demand is increasing, you're able to pay your bills.
Right. Rates are up.
Rates are up.
You got money coming in.
You're sitting pretty, right?
Yeah.
Why not go buy
it's an investment.
It's an investment, right? But we're a year later, Luke. It is now May of 2023, and that same $140,000 truck is now worth $85,000.
Talk to me. Tanner, what does that mean? I bought my truck at $140,000 when rates were at, $25 billion a mile. Now they're at, $213 a mile.
Yeah.
What does that mean for me?
So
What's that mean for me?
You know what? If you bought a $140,000 truck in the market last year, you had a 0% interest rate on a 5-year loan. You're 0%. So all you're doing is paying principal.
Easy money.
Easy. You're making $350 in the spot market. You're rolling in the dough. Yeah, I guess now what? Now that same truck that's worth $85,000, you've only applied $25,000 towards your principal. So you're upside down $30,000 in your loan, which again, it's fine if rates are rolling, but now you've got rates at a floor that have fallen to $30, $50 line haul in the spot market plus fuel.
Oh man. So all of a sudden, buying a truck as an investment kind of looks like, when, some knuckleheads buy their Pokemon cards and, hope that value keeps going up. There's a big Pokemon craze there for a while. Some of the Pokemon cards going for 6 figures, or even more in some cases. Anyways, yeah. So, that's a really tough situation to be in. Tough situation. And it looks like we might still be falling on these used truck prices. So basically what this means, Tanner, is I can't get out of this, right? I mean, I have to pay off the principal at a faster rate than the truck cost is falling in order for me to kind of catch that falling knife.
Correct, but you can't do that if you're not operational running a profit.
Right.
So if your costs are high and rates are dropping, you're not making enough revenue. You could be making enough revenue, Luke, to pay that truck payment, but you're not going to be able to make enough revenue to put any additional towards that principal.
Right.
And if rates do continue to fall, which we thought they were done, but they obviously aren't, if you're a smaller owner-operator or a smaller carrier that's running a lot of spot market freight and those rates continue to drop, you will start to get to a point where you can't make that truck payment. And Luke, what happens if you own a vehicle and you don't make your truck payments?
You don't have very long before it's taken away.
Before the repo man comes and gets you.
Yeah.
That's it. And that's the issue. Is I think you're going to start to see repossessions start to uptick. I think you're going to see a lot of people filing for bankruptcy, and that's an issue. And you know what? It might not affect our industry too much if it's an owner-operator here or there, but there were a lot of asset-based carriers that are in the 500 truck range, 800 truck range, 1,000 truck range that locked in an awesome contract 12 months ago. And they went out and upgraded their entire fleet. Yeah. So now it's just not one truck that's upside down.
All drivers got raises.
It's not just one truck that's upside down. It's all 400 that they went and upgraded. They're upside down.
And you got to think they have higher insurance premiums that they're having to pay, right? The maintenance cost is up, right? Obviously, your dispatcher's cost is up, right? Yeah, I mean, everything's up. Revenue is going down. Costs are going up. Revenue per shipment's going down. Number of shipments is going down. Costs are going up. That's a tough place. That's a really tough place to be in the market right now. You know, and I think, I mean, the signals were there, I think, in late 2021 that the market had already peaked and it was coming down, at least from a supply and demand perspective. So, you know, important to stay away from that. What I think is going to be interesting is, you know, do we fall back down to those 2019 levels or even 2020? I mean, if you look on that last chart, I know we took it away, but the 2020 truck prices were pretty low for most of 2020. It wasn't really until Q4 that they really started to increase. Yep. 2020 was the time to get in the market. I mean, my goodness.
Yeah, you were getting trucks at 30 grand, 40 grand, that's a 3-year-old truck. So back then in 2020, you're talking about a fairly decent 2017 Peterbilt. Like, that's a decent truck.
That's
back
great.
In 2020 for 30, 40 grand. And yeah, that's an issue. And I agree with you. I think these used truck prices continue to fall. I think another thing that's going to be an issue is that we saw a lot of brand new Class 8 truckload orders.
Yep.
I think Volvo came out 2-3 weeks ago. FreightWaves posted an article about it. How about their executive came out and said, we're not worried. Our backfill of orders is looking great. We've got more demand than we can even fulfill. Our forecast guidance is terrific. Well, Luke, what happens if rates continue to fall and some of those larger asset carriers start to cancel some of those orders?
All of a sudden, that backfill may not be there much longer. You got problems. Got to give an update to the shareholders.
Yeah.
I mean, it'll be interesting. I mean, listen, there's always going to be people buying trucks, always going to be people ordering trucks, right? I mean, we know that. Nothing's going to zero. At the end of the day, nothing's going to go to zero. Physical goods still have to move. We are in an inflection period right now where are we at the bottom or are we not? What I do think is going to be interesting is I don't think we're going to stay at the bottom very long. That's not to say that that's not to say that there's going to be a fast recovery. I don't think there's going to be a fast recovery. But I do think we will bounce off a bottom and then we will kind of enter into this period where we have kind of a sustained down period, right? So it's not at the bottom, but it's a sustained down period where the market effectively has to reset. I do want to go back. One thing that we talked about earlier with interest rates, I do want to say this real quick, because this will definitely impact everything as, you know, folks buy a lot of those new trucks as well. I do think the Fed increases interest rates at least one more time. And I think one of two things will happen. They either achieve their target of 2% inflation by the end of this year, and they continue to raise rates until they do, or they reassess and a new strategy has to form. And I think they'll have to make that decision by the end of this year. So interest rates could rise multiple times, which I think would surprise a lot of people. We could hit a 6% interest rate. I don't think the Fed wants to. I don't think they do.
No.
Well, I mean, what are we, terminal rate right now is 5%?
Mm-hmm.
That would mean 4 more 0.25% interest. They've already slowed down the interest rate hikes, going down to 0.25% now. I don't think they're done. I think they want to be done, but I don't think they're done. And I think we're going to feel the impact of that pretty soon. Now, flip side, we talked a lot about trucking rates, right? What does this mean as we look at the spot and contract markets? The spread is getting bigger, right? Tanner, what is the spread between spot and contract? Not necessarily the number, but like, what does it mean?
Yeah, the spread between the contract and the spot market is showing you the difference or the contracting or expanding of what's happening of the truckload market cycle, right? So the spread of rates tells us everything we need to know about how long the cycle is, how close we are to the end, how close we are to the beginning, where's the peak and where's the trough. So this is the chart. If you want to understand how long the truckload market cycle is and how close we're getting to the end of it, this is your chart. As you mentioned, the actual number is around the 90-cent spread, right? So we're looking at line hauls here. So there's no fuel manipulation in this. This is strictly just the blue line is contract line hauls, and the green line is the spot market line haul, right? And I agree with you, Luke. A couple minutes ago, you said that your thoughts were that you thought that we are getting close to a bottom on the spot market because, as we know, the spot market leads the contracted market, right? It pulls on it.
Talk to me.
So if we get to close to a bottom and we kind of level out and we don't really see an increase, I think that is your indication to getting to the back end or the closing of the current market cycle. And I think what you're going to see happen is what we're looking for here on this chart is about a 20-cent spread between the contract and the spot market. If you can get to a 20-cent spread, historically in the past market cycles, that is the ending of your trucking market cycle. So how I think we're going to get there, I agree with you, Luke. I think spot markets are going to eventually hit a bottom. They'll level out, and it's going to be the contracted rates that make up that difference to get to 20 cents.
Yeah, I totally agree. I think that's a great summary there. We're looking for that 20-cent spread there. Once we achieve that, we're typically in the clear of like, okay, the market has found a bottom, at least in kind of the near term, and then we can talk about maybe another cycle starting. And what's interesting is if you look at 2018 there, we don't have the spot rates there. That's just where the blue line starts. You see a big curve up because spot rates were really elevated in 2017 and even into 2018. They started falling in the second half of 2018, but contract rates rose a lot. Then to catch up to spot rates, then we can see there in the rest of 2018, they kind of leveled off together. And in 2019, things stayed level as well. So you had that period in 2018 and 2017 where the rise happened, and then we flattened off and we had a period of flatness. And I think that's what we're waiting for right now. Spot rates need to hit that flatness for an extended period of time. Contract rates come down, just like you said, 20 cents. And then we talk about another cycle starting. Now, in terms of what starts that next cycle, is it demand? Is it capacity leaving? Is there some black swan event? That's what we're going to figure out. Time will tell.
Yeah, absolutely. And I just don't see how, with everything we've talked about with interest rates, student loans, how the economy, inflation is going to react, I don't see that black swan event, I guess you could call it, like you said, happening from a demand perspective. I think it's going to have to come from a supply constraint or a capacity shortage. And Luke, looking at this chart, there's one thing that sticks out to me that I think leads to that. And if you look at I know the contracted line haul bubble is kind of blocking it, but the peak of the contracted market line hauls was May 22nd of 2022.
Yeah.
So we are about 5 days away from being almost a year ago when the peak of the contracted market happened. There was definitely contracted freight and RFPs and business that was locked in at the height of the market a year ago, right? And as we know, it's pretty common for contracted business to run on 12-month cycles, right? You lock in a 12-month rate, you hold on to that, that's what you get paid for 12 months. But Luke, the big thing that is kind of worrisome to me and something that I'm communicating with our customers is, hey, if you're a carrier that locked in those contracted rates 12 months ago, right now you're in the process of rebidding those same contracts. So if you've been getting paid $3 a mile line haul on a contracted lane, you are now going to have to rebid about 50 cents per mile less than what you've been getting paid.
Wow.
And not to mention that brokerages, third-party logistics company, have gotten extremely, extremely aggressive about chasing after contracted business. So even though technically the average line haul right now is $2.46, there are definitely companies out there that are going underneath what the current rate is, hoping to obtain additional business.
Yeah.
So Luke, from a carrier's perspective, or really anybody's perspective who was locked into contracted rates, what does 50 cents per mile less in revenue do to you when one day you're making it and the next day you're not?
I mean, we can look at C.H. Robinson. C.H. Robinson from a year ago, that when they reported earnings not long ago, over a 20% drop in revenue. That's, I mean, you talk about you don't get to report a 20% drop in revenue. You know, that is extreme. Now Wall Street didn't care, and they actually treated their stock quite fairly well, which is, I don't know what's happening over there, but nobody really knows what goes on in the stock market. Anyways, but the point is that you start to have, drops in revenue of that extreme. You need to tighten up your business really quickly. You got to trim the fat. You got to trim the fat. It doesn't necessarily mean layoffs. Sometimes it does, but you got to find ways to cut costs and just run a much leaner, more optimized business, much better utilization. You don't get to make mistakes at that point when you have a drop of that extreme.
Yeah, you don't. And I think what we're going to see happen, in my opinion, is I think a lot of these mid to large size carriers, so I'm talking 500 to 2,000 truck assets, a lot of those guys, yes, they made pretty good money over the last year, but I don't think they were stockpiling it as much as some of the giants. So my fear is that I think that 500 to 2,000 truck range, that's who's going to get hurt the most from this. Right?
I think we're going to see a lot of consolidations.
I think
we're not done. I mean,
no.
We saw the Knight-Swift U.S. Express one, which is still in the process of being executed, but I think we're going to see a lot of consolidations in order for some of these companies to stay afloat. Because the reality is, and we know this, right? Trucking cannot go to zero. Physical goods have to move. Period. End of story. But I think we are going through such a painful period here to reset. The trucking market that comes out of this on the other side is going to look very different than the one that came in. There's always going to be owner-operators. There's always going to be small, mid-sized fleets. But I think the bigger carriers are going to consume more. Remember, the biggest trucking company in the U.S. really only has about 2.5% of the market. Imagine if they double to 5. Mm-hmm. Maybe they double again to 10, right? We've never really been in an industry in the market. We've never seen a trucking market before where anybody has more than 2 to 3% of the market. Imagine if we start going through some of these cycles where you have a trucking company with 20 or 30% of the market. We look at the shipping industry, right? The ocean industry, right? The top 10 shipping companies own 85 to 90% of the world's capacity. And the ocean markets went through a much bigger bull run than the truckload markets did. But then they've also fallen way harder on the flip side. If that consolidation continues, what impact does that have on those future cycles?
I think that if it comes to that, I think eventually we're going to have regulation step back into the industry. It's been so deregulated since the 1930s when that act went into place. It's an open, free capital market, which is great, and that's what America's about. But yeah. I think you have a chance to see the government possibly step in. And the reason I say that is because 2008, housing crisis, there was a lot of really bad compiled assets on companies' books from unrealized gains. 2023, exact same thing, except with the banking sector, right? Oh. SVB, some of the First Republic banks, they had a lot of really bad compiled assets with a lot of really large unrealized gains or unrealized losses. The same thing could possibly start to happen in the logistics industry.
Yeah, it's true. We'll have to see what happens. It'll be really interesting to see how it plays out. Anyways, folks, thanks for tuning in. We'll see you again next week. Remember, we have Future of Supply Chain in June. It's going to be a great event. There's never been a better time to come to one of these events, okay? You will have everybody that you could possibly want. Every industry leader is there. Remember, we're in a really tough time in the market, okay? We are not going to zero, okay? There is a place to weather the storm. There is a place to come out of this on top, right? We're gonna have to think differently. We're gonna have to be strategic. Love to have you at the event. I think it'll be a great time if you're able to make it. But if not, we'll see you live next Wednesday, of course. In the meantime, have a fantastic rest of your day and look for clips here on some of our social media platforms like YouTube and TikTok and others. Have a great day.